3 long-term stocks heading into February 2019. Let's get started. What's up, everybody? My name is Ala and welcome to my world of stocks. Now, I know you guys like timestamps, so I left some for you down below in the comment section. All I ask is that you please hit the like button if you enjoy this series. Just taking 1 second of your time really helps the channel survive and grow, and I really appreciate it. Having said that, this is the monthly series where I talk about 3 different stocks every single month, and it's a very hard thing to do. So please make sure that you do your own research and make your own decisions. I'm not anybody's personal stock picker. I'm just here to share my opinions on some different stocks. All right, guys, starting with stock number 1, we've got a bank stock. I know we almost never talk about bank stocks on the channel, but you know, my portfolio is very tech heavy, and so a pretty long while back I decided to diversify it a little bit and I added a bank stock. And because I'm not very well experienced in the banking industry, I decided to go for pretty much the biggest bank out there that in my opinion is the best run bank as well, and that happens to be JP Morgan Chase, ticker symbol JPM. Now, admittedly, my cost basis is well under $100 a share, and I've never bought above that level, which it currently sits above right now. But with all the volatility in the market lately, I don't think it's too crazy to predict that the stock could possibly dip back down under 100 sometime in the near future, in which case I may consider adding again. But even at its current price, you're still getting it for a cheaper price than what Warren Buffett paid. I know that sounds crazy to me too, but it's true. Warren Buffett's Berkshire Hathaway bought over 35 million shares of JPM in the third quarter of 2018 that equated to over $4 billion. Now, in that third quarter, JPM was trading well above $100 per share and mostly above $110 per share. And according to Markets Insider, they estimate that Warren Buffett paid over $112 per share, which would be about a 9% higher increase, or be about a 9% higher price than what they currently trade for, which is around $102 per share at the time of this recording. In any case, bank stocks had a rough 2018, and it seems that the rate hikes didn't help as much as bulls were expecting, so JPM is actually down close to a double-digit percentage in the past year, but has still performed very well in the long term, having climbed by over 75% in the past 5 years. And when looking at their valuation, according to SeekingAlpha.com, they have a trailing PE of around 12, a forward PE of just 10, a PEG ratio of less than 1 when factoring in growth, so it's still a pretty attractive valuation. And despite being considered one of the more expensive bank stocks out there, they're also the most profitable of the big 4 banks, with a 14% return on equity in Q3 of last year, beating out the other 3 big banks. Not to mention that its growth is looking better as well, at least when compared to Bank of America and Wells Fargo, which both have higher PEG ratios, especially Wells Fargo, which is as high as 2.3. In any case, the real reason I invested in Chase to begin with was to diversify my portfolio and to collect some great dividends. Speaking of which, JPM's dividend yield is above 3%, their payout ratio is very reasonable at 32%, they have a great 5-year growth rate that is pretty close to 20%, and they've been increasing those dividends every single year for the past 8 years. And while that growth history could certainly be larger if it wasn't for the 08-09 financial crisis, they have at least paid those dividends every year since the mid-90s. Having said that, we have been living in a rising rate environment, and usually the stock market takes big hits during that time, which is what we've been seeing lately, but banks tend to perform pretty well because their profit margins actually go up. Now, to be fair, I do expect the Fed to slow down in 2019, and another concern is that consumer debt is very high as well. But it's also true that wages have gone up, unemployment is very low, and consumer confidence is also pretty high, which tends to lead to more bank loans being taken out. In fact, here's a chart that shows unemployment in the US, and it's at some of the lowest levels we've seen in decades. And then here's another chart that shows the Consumer Confidence Index for the past decade, and you can see that we're at some of the highest levels here as well. Now, it is true that they just reported Q4 earnings this past week, and it did miss top and bottom line estimates with a significant earnings surprise of about negative 10%. However, this was coming off of 15 straight quarters of earnings beats, which is incredibly impressive. And when you break down their earnings, the main reason for the miss was due to trading revenue coming in at $300 million lower than expectations. Keep in mind that they only missed revenue by around $25 million. So obviously the weakness that they saw in trading revenue was offset by other parts of their business, and that's why I love Chase, because they're very well managed and they're very well diversified. In fact, let's take a look at their different segments. Year over year in consumer and community banking, they saw average core loans up 5%, average deposits up 3%, client investment assets climbed 3%, and credit card sales up 10%, with debit sales up 11% and merchant processing up 17%. And that's a big deal, especially in their credit card business, because they've been investing in that pretty heavily. In fact, my Amazon Prime credit card is issued by Chase, and because they give me 5% back on Amazon purchases, I use that credit card almost exclusively over anything else. Moving on to corporate investment banking, we saw the weakness in total markets revenue down 6%, but equity markets was still very impressive in a volatile quarter, up 15%. So many people think that these banks can't make money during volatile times. They actually can, and a lot of times by a lot. And then Treasury Services was up 13%, with Security Services up 1%. The commercial banking improved a little with loan balances up 2%, and then finally their asset and wealth management segment saw loan balances up 13%, and while assets under management shrunk by 2%, they still have a total of over $2 trillion, which is enormous. And all of this helped them have a record-breaking fourth quarter and record-breaking year, with net income at over $32 billion for the year, and for the quarter, net revenue still increased by 4% year over year. So is this a really exciting company that is growing at a huge rate? Probably not, but what it is that it's a very well-managed and stable bank out there that offers some diversity to your portfolio. In my case, again, very tech heavy. Like, you guys would probably think I'm an idiot if you saw my portfolio. A lot of people ask me for my portfolio, and I don't like to give that information out because I don't want to open it up to the enormous amount of criticism that I would probably receive. But again, a bank stock offers me a little bit of diversity. I did buy it a lot lower, admittedly, so I'm not really buying at above $100, but if you can catch it lower, then maybe it's a good long-term investment, considering that they do have pretty stable long-term performance, and they also have a pretty solid dividend that is being paid out at reasonable payout ratio and has some growth behind it and has been paid for a long time. So again, just offering some diversity and a good, reliable dividend, and that's why I like Chase. Okay guys, now the second stock that we're talking about today is actually a stock that I'm gonna be honest with you guys, I have never been bullish on this stock. And I only recently started being a little more attracted to it. And we did talk about this stock on my Sunday Stock Battle series, where it was PepsiCo, so that's the company, versus Coca-Cola. And that was pretty much the only, I think I talked about it one other time in a dividend stocks video, but I never had it on the monthly series. And so today I thought we should finally talk about it. So again, this is PepsiCo, ticker symbol PEP. Now there are several reasons why I'm becoming more bullish on PepsiCo in the long term, and we'll get into those in a second, but a couple is just because it's a very stable, reliable company, and their business is pretty stable, and then their dividend is very reliable. And you guys know me that I'm a little bit more of a growth investor and a dividend growth investor, so PepsiCo, maybe doesn't really fit that criteria. But what it does offer is it offers a lot of stability. So sticking with the whole diversifying trend that we're doing today, we talked about a bank stock earlier, PepsiCo would offer me some very stable and reliable dividends that you don't always get with dividend growth stocks. A lot of times you get some growing dividends, but they may not be as reliable, and PepsiCo is definitely reliable. Having said that, I'm still not invested in PepsiCo myself, but again, it is catching my attention more and more, and I may open up a position soon. But let's go ahead and start by looking at the stock, and then we'll look at some of the reasons why I'm liking them. Now, they've been more volatile than usual in the past year and are actually down over 8%. And while they only increased by a little over 30% in the past 5 years, their share price has more than doubled in the past decade and sports a pretty smooth upward trend. Of course, a major market crash will derail that, but in the long term, I'd expect Pepsi to repeat similar performance, given a few catalysts that we'll talk about in a second. But first, I want to talk about their dividends, because this is where I really see the major stability that a stock like this can add to an otherwise high growth portfolio like mine. They have a very nice yield of 3.4%. Their payout ratio is a little high though. I generally like them to be under 50% if I can get it, but Pepsi is a little over that at 63%, but they have a very close to a double-digit 5-year growth rate of almost 10%, and the most impressive metric here is their absolutely enormous growth history of 46 straight years. That means that through recessions, market corrections, and even major market crashes, PepsiCo has increased that dividend every single year for the past 46 years straight. That is really impressive and demonstrates a very reliable and growing dividend. Now, there's definitely some concerns with this stock. For one, the company isn't growing very much. In their last quarter, revenue only jumped by 1.5%, and their past 3 quarters combined only saw a revenue climb of 2.6% year over year. Although to be fair, non-GAAP organic growth was a bit higher at almost 5% for the quarter. Still, my biggest concern for the company is that people seem to be becoming more health conscious and aware of the negative effects of sugar and artificial sweeteners. Of course, that's bad news for PepsiCo, since they own brands like Pepsi Cola, Mountain Dew, Sierra Mist, Gatorade, and even a bunch of snack foods like Frito-Lay's, which includes Doritos, Cheetos, Fritos, Ruffles, and Tostitos. On the other hand, those are some pretty strong brands that I don't see consumers all of a sudden stop buying, and the fact that they're not just a soda company, but also offer these other products like snacks, waters like Aquafina, sports drinks like Gatorade, teas like Lipton, and juices like Tropicana makes them pretty well diversified. And while I do think many of those brands are still unhealthy, they are at least trying to make them a little healthier by offering more baked chips and reduced sugar drinks and more teas and juices. Although I'd argue that some of those aren't very healthy either, but it still works better for marketing and consumers still flock to those regardless as a healthier alternative. However, one of the things that I really like about PepsiCo is that they are making moves and acquiring a lot of their really smaller competitors. In fact, they just acquired SodaStream, which helps bolster their more health-conscious lineup because it's a carbonated water maker that customers can use at home to create their own carbonated drinks. And this not only helps PepsiCo tap into a brand new market that involves do-it-yourself drinks, but SodaStream is actually a high-growth business as well that PepsiCo can definitely use at this time. In fact, in their last reported quarter, SodaStream grew revenues massively by over 30% year over year. Of course, their revenues are like literally nothing compared to what PepsiCo does in total, but now that they'll have the resources of a giant corporation, I do expect SodaStream to be marketed more heavily and become even more popular. So to sum it up, I think PepsiCo is one of those big companies that has its flaws just like any other corporation out there. But I think as long as they continue to develop their health conscious lineup more, offer more healthier alternatives, and continue to acquire a lot of these small high growth companies like SodaStream, and keep paying those very reliable and growing dividends, then I think the stock starts to become a lot more attractive for the long term. Now, I'm personally waiting a little bit longer for a dip in PepsiCo. I think they're still a little expensive when you consider that their PE ratio, I think it was like at 31. Their forward ratio did improve drastically, but it was still like at 18. So it's still a little expensive. But you know, if this market volatility continues or we ever get that market crash, that huge crash that everybody's been predicting, you know, every year for the past decade, then I would definitely look at PepsiCo and I'd be looking to pick up a few shares, especially for that dividend. Okay, now for the last stock of the video, I decided to do something completely different. The last 2 stocks were very slow growing, a lot safer, more reliable companies. This one is a much riskier, very high growth company. And the stock is 2U, ticker symbol TWOU. Now, I did talk about this stock about a year ago, but it was still just too expensive, a little risky, and the price was just too high for me, so I never picked up the stock. But thankfully, now with all the market volatility, this stock has gotten absolutely crushed, which does make me a little fearful if we ever get that huge market crash. I imagine that this stock would get crushed even more. But having said that, the stock is down huge. We're going to talk about that in just a second. But first, I want to talk about their business and what they do. Now, they offer an online education platform for their customers. And when I say customers, you know, this is usually big colleges or universities that they partner with. And then what they do is they provide them with software to allow them to teach college or university level courses and materials. So it's like an online education platform. And we'll get into why that's such an interesting market for me in a second. But first, let's talk about their stock and how much it's been hit lately. Just in the past 6 months, the stock is already down almost 40%, and the drop from their 52-week high of 98 is a drop of about 44%. So needless to say, despite not being profitable yet, their stock price is much more attractive to me now than it has been in the past, given that it's now significantly cheaper. So why am I interested in this stock in the first place? Well, back when I did my master's degree, I was friends with a lot of my professors, and they all basically told me the same thing, which was that online enrollment was going way up and physical enrollment was going down. And a lot of the teachers, if they didn't know how to teach an online course, if they weren't certified to teach online courses, then a lot of times they were left kind of in the dark without many classes to teach. And a lot of the, more experienced teachers that were certified were basically getting way more classes because they were able to teach all of these high demand online courses. In other words, students didn't really want to come into class anymore. They wanted to take online courses. And I think that's a trend that we've been seeing for a while. In fact, here's a survey from Babson Research Group that shows that students signing up for online courses has grown every year for the past 13 years. And by the way, this is from late 2016, so it's probably even higher by now. But the percentage of students taking online courses also increased to over a quarter of them at 28%. And it goes on to say that even while higher education enrollment has been declining, online education has had an inverse relationship as it continues to climb despite that. And it also says that the majority of academic leaders recognize this and understand that online learning is critical to their institution's long-term strategy. In other words, just like those retail businesses have to adopt to online shopping if they want to survive against Amazon and things like that, these schools and universities, they need to adapt to online classes, which is what everybody wants. And that's especially the case if they want to survive and keep enrollment rates up. And the good thing for 2U is that this is exactly what they specialize in. Now, they have over 42,000 enrolled students, 34 university partners, over 80 short courses, and 64 different programs. Not to mention that they have almost 50 grad programs that is expected to more than double in the next couple years. And they're even starting to roll out international graduate programs this year, starting with an MBA at University College London. And just looking domestically, they've already partnered with some of the largest universities in the country like Baylor, NYU, Oxford, USC, Yale, Vanderbilt, and even Harvard. And most of their contracts are for 15 to 20 years, with many of them being well above 20-year contracts and still expected to last well beyond 2030. And while they're not expected to be profitable in fiscal year 2018, they are guiding for their fourth quarter to at least see positive net income, even on a GAAP basis, thanks in large part to soaring revenue growth that has climbed by almost 50% year over year in each of their last 4 quarters, which is really impressive. So given the massive drop in share price, given the high growth market that they operate in, given the enormous revenue growth that they've been seeing for a while now and continue to see, this stock is becoming much more attractive to me. Now, there are still some concerns. Obviously, it's still a speculative stock, and I already have a couple spec stocks, so I don't know how many more I want, but this is a stock that I would love to pick up. And the whole issue of not being profitable yet, I think I think they will become profitable soon, but it's going to take a little while longer. But if we ever get a major market crash, I could also see this stock getting crushed. So again, I feel this is a high risk stock, but in the long term, I don't know, I see a lot of potential with this company. Okay guys, I think that just about wraps it up. If you enjoyed this video, make sure you hit the like button. Leave me a comment down below. What do you think about any of these 3 stocks? Thank you so much for the support, guys. It really means a lot. The channel is growing, and I really hope that it continues to grow. I'm hoping for big things. I'm hoping that I can put out more videos for you guys. And really the best way to do that is if I can have the channel grow more. And the best way for it to grow is if you guys are supporting the channel just by hitting the like button and doing little things like that. But thank you for all the support, guys. I will catch you guys in the next video. Take care. Bye-bye.